By the time you reach age 50, retirement savings needs to go from just saving to saving intelligently, saving wisely. I've got the top tax strategies that you need to know by the time you turn age 50. That and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. If you're not strategic about tax planning while you're saving up for retirement, then you can see Uncle Sam in taxes erode your retirement lifestyle and your retirement savings by the time you get there. Imagine spending your entire career being diligent and consistently saving up for your financial future, only to see too much of your hard-earned savings going to Uncle Sam and you needing to not live the lifestyle that you want in retirement, even reduce how much you spend. That's why tax planning is so critical. Tax planning is one of the 6 areas of your financial life. And the big idea with tax planning, it's not tax preparation. That's important too. Tax planning is the proactive work. Tax preparation is reactive. Planning on identifying opportunities, ways for you to improve your tax picture throughout your entire lifetime, if not multiple lifetimes. Not just each year in and of itself. That means throughout your career, you're thinking ahead proactively. Okay, what's my tax picture today? What do I think my tax picture is going to be like in retirement? And therefore, what choice should I make? Should I be doing pre-tax? Should I be doing Roth? And you're aware of those strategies and how what you do during your savings, during those years when you're saving, how that's going to impact the retirement you. So today I'm covering the top 3 tax strategies that you need to know and rule in or rule out with your CFP by the time you reach age 50. And this is above and beyond that big decision that I just mentioned, the choice of, well, should I be maxing out my 401k and should it be pre-tax or should it be Roth? That's the quintessential financial planning decision. I'm trusting that you're making that decision with your CFP all along the way. That's important, but above and beyond that, what are the tax strategies that you need to know? The first is the Roth conversion. This is where you're shifting dollars from pre-tax, either the pre-tax side of your 401k or the traditional IRA, and you're shifting it over to the Roth so that it can grow tax-free for the rest of your life. Now, you can do that within your 401k, assuming your 401k has the Roth side to it. You can do an in-plan conversion, okay? Or you can take your IRA, either all or part of it, and shift that to your Roth. This is a taxable event. When anytime you're pulling dollars out of an IRA, even if it's just to convert them and move them to the Roth IRA, that still is going to show up on your taxes. Therefore, you're going to want to be very, very mindful of how much. One of the most common questions we get with the Roth IRA is, do I have to do a Roth conversion? Do I have to do all of it? Do I have to do my entire IRA? No, you can do a portion of it. But the big planning strategy is, how much should you do in these tax years and how do you cover the taxes? Why is this important to know and be discussing on an ongoing basis every single year with your CFP by the time you reach age 50? Because you still have time. You still have time for those dollars in the Roth to be positioned to grow, compound for your financial future. There's also still time, whether you're planning to retire early or at 65, or maybe even a little bit later, there's time for those dollars to grow, positioning more dollars to grow tax-free in the Roth so that it optimizes the taxes that you might pay on your Social Security, potentially reducing those, and optimizes and limits the chance that you're going to have to be paying IRMA, income-related monthly adjustment amount, by the time you're on Medicare. And lastly, Roth conversions help you manage and avoid future required minimum distributions on your pre-tax accounts, pre-tax IRAs, pre-tax 401ks by the time you get out there into your mid-70s. So knowing the Roth conversion, ruling it in, ruling it out, must be something that you're aware of by the time you reach age 50. Second tax planning strategy you need to know by age 50, the mega backdoor Roth IRA. Sounds super exciting. This is actually one of the lesser known and lesser used tax strategies out there. Similar to the Roth conversion, this is a strategy designed to see how much money, or be creative in getting more money into that Roth side of your portfolio so that the growth can be tax-free out there in the future. In order to do the mega backdoor Roth IRA, you need to have a 401k, but one that allows for after-tax contributions, not just pre-tax or Roth. This is after-tax. Why? Because if you're allowed to do that, you can contribute above and beyond the normal $23,500 limit that you have to your 401k, either traditional or pre-tax, you can go all the way up to around $70,000. You need to be aware of profit share or company match, but you can do a lot more into your 401k tax sheltered in the after-tax side if it's allowed. And then if your plan allows for in-service withdrawals or in-plan conversions, you can then shift those after-tax dollars into the Roth side of your 401k or into your Roth IRA. This is a different way of getting dollars backdoor after tax than into the Roth, and doing it in a mega way because that contribution limit is so significant. So what's this mean for you? Potentially turbocharging your Roth savings, getting more and more of your wealth growing on the tax-free side in that Roth IRA, improving your tax picture in retirement so that as you supplement your Social Security or withdraw dollars, less dollars are having to go to Uncle Sam, more dollars in your pocket. Finally, let's talk about the HSA, the Health Savings Account. The third strategy that you need to know from a tax planning standpoint by the time you reach age 50 is something called shoeboxing your HSA. Imagine with an HSA, the ability to have pre-tax contributions go in, so getting a tax deduction on your contributions, having all of the investment activity and growth be sheltered from tax, and the withdrawals, both the amount you put in and the growth, come out tax-free. Imagine applying that trifecta of tax benefits to a retirement account. And how do you decide that? Simply shifting your perspective and use of your HSA from a spending HSA, whereas you put money in and then have medical expenses, you pull the money right back out, to an investing HSA or a saving HSA. What's the difference? Well, as you make a contribution into your HSA, doing as much as you possibly can up to that limit each year, but then as you have medical expenses, figuring out how to fit those in your budget. Instead of withdrawing them out of your HSA, pay for those out-of-pocket medical expenses out of your pocket and hold on to the receipt. And because you've now positioned your HSA to not need to withdraw dollars in the short term, you then said, well, these can be invested for the long term. And because it's invested for the long term, that will give more time for that HSA account to grow, tax sheltered growth, and grow compound for your retirement. Then the magic happens. You show up at retirement with an even larger HSA because you haven't been spending it, you have been investing it, and it's been growing over time. And you've got a shoebox full of receipts that you can then reimburse yourself for in retirement from your HSA tax-free. In addition, of course, you're going to have medical expenses in retirement, and the qualifying medical expenses you can also withdraw from your HSA tax-free. Even though you're still on Medicare, you just wouldn't be eligible to continue to contribute to your health savings account. So by the time you reach age 50, it's not just about saving more, it's saving smarter and saving more wisely, and doing so from a tax planning perspective, proactively looking at strategies for you to improve your tax picture over your lifetime, not just on an individual year-by-year basis. By the time you reach age 50, you need to know these 3 tax strategies and others and consider whether they make sense in your financial life. Tax planning is identifying the opportunities. Financial planning is knowing which ones to use and which ones to say, that's a good idea, not for me or not for this year. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.